Well, hi, good afternoon, everyone, and welcome to Withum's Real Estate Year-End Tax Planning webinar. My name is Rebecca Mashinga, and I am the practice leader of Withum's Real Estate team. We have a great panel of presenters for you today, so I just want to take care of a few housekeeping items first. We are recording this presentation, so we just wanted to let you know that. We'll have you out of here by 2 o'clock today. And if you have any questions, you can put them in the chat box, and we will either address them after each person gives their presentation, or potentially at the end. We'll kind of play it by ear. And after the presentation, the slides and the recording will be emailed to those who participated, and will also likely be on our website for others to take advantage of seeing. So we'll kick it off right now, and I'd like to turn it over to Brian Lovett, who is our real estate tax team leader. Brian.
Thank you, Rebecca, and welcome everyone. So just wanted to take a couple minutes and talk about, what we'll cover today before we turn it over to the panel and get started on the actual topics we're going to talk about. We're going to start today with a little bit of planning for year end. Some ideas and updates on what's changing, what to be aware of over the next 3 or so weeks as we approach 12/31, and tax law changes as they're impacting the current 2022 tax year. After we do that, I just want to turn our attention a little bit to the Inflation Reduction Act and some of the changes that are going to take place for 2023 and beyond. It's really, I think, important as we think about placed in service and some of the things we're going to talk about to understand what changes are on the horizon, why it may make sense to place projects in service now, or may make sense to wait and place those projects in service next year if possible. So we'll talk a little bit about some of the energy incentives the Inflation Reduction Act introduced or largely extended, things we all knew about before, expanded those programs, and we'll talk about them briefly there. And then Rebecca will close us out with some updates on K2 and K3. Dirty words in tax these days, and nothing we're really excited about, but we want to make sure everybody's up to speed on the latest and greatest in that area. As Rebecca mentioned, there is a chat box. If you have questions about the topics as they're being covered, feel free to drop those questions into the chat box. And I'll monitor that as we go, and I'll reach out and ask those questions of the presenters as we move along. The first section on year-end planning is going to be covered by Ryan Williams, who's a manager in our group, by Brittany Perez-Trapicio, who is a senior manager in our group, and by Sarah Palovic, who's a partner in our real estate group. They're all going to kind of take these topics as they go. Ryan's going to cover bonus depreciation, Brittany will cover 163J, and then Sarah's going to take care of tax deferral. I'm going to turn it over to Ryan now, and I'll be back when they're all done to talk about the Inflation Reduction Act. Ryan.
Thanks, Brian. Thanks for the introduction. I'd like to be the first here to wish you and your families a happy holiday season. Hopefully, it's a good time of year to get together with family and kind of take a little break from the year that's passed. So like Brian mentioned, I'm going to cover bonus depreciation, which, is usually a big tax planning idea and incentive for real estate investors in particular. So you can go to the next slide. So in 2017, the Tax Cut and Jobs Act extended the 100% additional first-year depreciation deduction, which we like to call it bonus depreciation. Bonus depreciation generally applies to depreciable business assets, both new and used, with a recovery period of 20 years or less. Some items include machinery, equipment, land improvements, etc. The asset, in order to qualify for bonus depreciation and in order to take the 100% deduction in the current year, the asset must be placed in service and purchased before the taxpayer's year end in order to take advantage of that deduction. Next slide. So one of the big issues with the Tax Cut and Jobs Act was it was originally intended to include qualified improvement property as 15-year property. Before the Tax Cut and Jobs Act, qualified improvement property was 39-year property and therefore was not eligible for bonus depreciation. However, due to a drafting error, the qualified improvement property under the Tax Cut and Jobs Act was not explicitly included in the definition of 15-year property, which therefore left a lot of taxpayers, and specifically real estate investors, pretty frustrated that they kind of left that out of the Tax Cut and Jobs Act. So qualified improvement property is any improvement that is Section 1250 property made by the taxpayer to an interior portion of a non-residential building. Now, that non-residential building has to already be in existence, and can't be part of a new building that's constructed. Qualified improvement property can also be eligible for bonus depreciation unless the taxpayer is a real property, trade, or business and has elected out of the business interest deduction limitation under 163J, which Brittany will kind of touch on a little further in our presentation. So the COVID-19 pandemic turned out to be a slight blessing in disguise for real estate investors. And the reason being is that gave the IRS and the Treasury the opportunity to make an adjustment to the definition of qualified improvement property as far as 15-year life. And they were able to change it from 39-year to 15-year, which now made those costs eligible for 100% bonus depreciation. And that fix was actually made retroactively back to January 1st, 2018. So a lot of taxpayers and a lot of clients of ours were able to take advantage of that retroactive change, and were able to make amendments to their previously installed qualified improvement property to take advantage of that deduction. So a couple of things to note for tax year 2022 and beyond. The 100% bonus depreciation is set to start decreasing in tax year 2023, which means 2022 is the last year to take advantage of the 100% bonus depreciation. And starting in 2023, the bonus depreciation is going to go down to 80%, and then will decrease by 20% each succeeding tax year until it's fully phased out in 2027. So with that being said, I know it's December 5th, so we don't have a ton of time left, but if you do have any machinery, equipment, or land improvements, or any kind of projects on the horizon that could possibly be paid for and placed in service before December 31st, 2022, we would advise taking advantage of that. That way you can, take advantage of the 100% bonus depreciation, which is, like I said, going to be pretty much expiring at the end of this year and will be fully phased out by 2027.
Thanks, Ryan. No questions, so you're clear. If any questions come in as we go and you think about what Ryan said, don't hesitate to drop those questions in there. But as Ryan said, start paying attention to those place in service dates and anything you can do to accelerate if you're looking for that 100%. You're running out of time. Brittany, I'll turn it over to you.
Thanks, Brian. Good job, Brian. So 163J, it's a tax provision that dictates how much business interest expense the taxpayer may deduct in any given taxable year. And the limitation is calculated as follows. The business interest expense may not exceed the taxpayer's business interest income for the year, plus 30% of the taxpayer's adjusted taxable income, which we'll discuss, and then plus the taxpayer's floor plan financing interest expense for the year. Any business interest expense that is not allowed as a deduction due to this 163J limitation is generally carried forward and treated as a business interest paid or accrued in the following tax year. Next slide. So what is ATI? ATI actually is modified for 2022 and forward. So adjusted taxable income previously included depreciation, amortization, and depletion. And it was an add back, which would make ATI larger, which would make your limitation smaller and allow you to take a higher deduction. For 2022 and forward, you're no longer allowed to add back your depreciation, your amortization, and depletion. And this is going to lower your ATI. ATI, again, is limited to 30% when you're looking at your total deduction limitation. And so this is going to reduce your allowable business interest expense for the current year. Again, you can carry it forward as paid or accrued in the following year. Another item that has developed and continues to, this is indexed for inflation, is that if you are a small business, which is considered to have average annual gross receipts for $27 million or less for the previous 3 tax years, and it's determined annually, then you're not subject to this 163J limitation. And then there is the option to elect out, which Ryan briefly discussed. And the issue with electing out There is a trade-off between bonus depreciation and this 163J limitation. So if you are an electing real property trade or business, which is any real property development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, or brokerage trade or business, you can make a one-time irrevocable election. It is irrevocable, so you would have to get the IRS's consent, which is a large process to undertake in order to revoke this election, and you would have to attach some procedures. So you have to attach a statement to the federal tax return for the year of the election. And again, when you do this, you then have to use ADS for your property, and that is all property. Anything under 10 years or 7 years really will still qualify for bonus depreciation, but your 15-year property will become 20-year property, so it won't qualify for bonus depreciation, and then your 39-year property will become 40-year property, and it won't qualify, but it never does qualify. So that one's not too big of a deal, but the big one is that your 15-year property then becomes 20-year property, and you're not allowed to take bonus on it. And I think that's it for me. Yep.
Thank you, Brittany. I do have one question for you before we move on to Sarah, and then I think I'm going to grab Ryan back because I got a couple of questions that float in on bonus depreciation as well. So I have one here for an entity has a carry forward loss. So I hear that as some kind of corporate entity with a carry forward NOL. Are the 163J limitations applied before or after the carry forward loss? You want to take that one? Where you want?
I believe they're applied before NOLs.
Yeah, I think an NOL is an add back. In calculation of ATI, I think you have to add back that NOL. So you're really going to be calculating it on your current year taxable income, not taking into account those carry forward losses to do your current limitation. So Ryan, I see you pop back up. Let me turn my camera on so we can actually talk to each other. Being lazy. You said paid for, assuming financed is okay too, is the first question.
Yes.
So it's financed or cash. It's just got to be a closed transaction, right, and acquired.
Correct.
Next question. Does bonus depreciation apply to residential? And what does an owner need to do to put that residential property placed in service?
So,
Yeah,
Brian, I don't know if you want to.
Certainly going to apply to residential. Yes,
Yeah.
absolutely. In the residential context.
Yeah, the only one that's not going to is the qualified improvement property. So the qualified improvement property is non-residential, so commercial only, and QIP which is what we call it, the acronym. It's also going to be interior building for qualified improvement property. But yes, bonus depreciation can be eligible for residential.
And as far as what do you have to do to place it in service, this is the age-old question. I mean, how do I know something's in service? The way the IRS defines it in some of their literature is that it's ready for its intended purpose or use. So if you have a building and you have, I know when we talk about property, a lot of times we look at what is your CO date? Is it ready to put tenants in there? Have you been trying to put tenants in there? You know, I think you with residential, you have this, slippery slope that says, hey, it's ready, it's there. I really haven't done any marketing. I haven't even tried to put tenants in there. Is it really in service yet? The guidelines that you'd find would be, is it ready for its intended purpose or use? And that's how you know it's placed in service. Kind of a gray area as we get to the end of the year, definitely something to follow up and talk about more, but it will apply to residential properties. So any of that stuff inside that can be carved out and put into that under 20-year class life is going to be eligible.
Right, and then real quick, I actually didn't really add this to the slides, which I usually try to do. It's a lot of people sometimes also ask, what's the difference between Section 179 and bonus depreciation? And my answer there, the biggest difference there is 179 can't be used, to reduce your income below zero, your business income below zero. So that's where bonus depreciation has an added benefit. You can use the 100% bonus depreciation even if you have no taxable income in the year for your activities. So that's another thing to take into consideration.
Right. Yep. Especially as bonus starts to phase out, I think we'll get a lot more questions about 179 since that's your immediate expensing provision. All right. Thank you. I think those are the questions. Now we've cleaned those up so far. And now we're going to turn it over to Sarah, and she's going to tell us a little bit about some ideas and strategies for tax deferral.
Thanks, Brian.
So when we talk about tax deferral, in this instance, we're talking about deferring a gain. So when we sell a capital asset, the difference between our basis and the purchase and the sales price would be either a capital gain or a capital loss. If you hold it for longer than a year, it would be long-term, which have favorable rates, and net short-term capital gains are subject to ordinary income at graduated tax rates. So when we're talking about deferrals, the first opportunity for deferral that we are talking about is 1031. Not going to go through the rules and how you go about doing a 1031 exchange, but hitting on the key points, 1031 substantially changed with the Tax Cuts and Jobs Act. Prior to the Tax Cuts and Jobs Act, you could exchange like-kind property of a business property for another business property, machinery, things like that. Post TCJA, like-kind exchanges now are only for real property. So land improvements, property that's real property under state law, no longer real property in a trade or real property used for personal purposes such as your home. You can't do a 1031 on property held primarily for sale or any personal or intangible property. So also included that is you cannot do a 1031 of partnership interests. So the TCJA substantially changed that for us and left us only real property. You have to keep in mind a few rules relating to 1031s. Most common is that you can't just sell a property, buy another one, and report a 1031 exchange on your tax return without going through a qualified intermediary and sticking to the time constraints of identifying the replacement property and then acquiring that replacement property. So that's a really common misconception that, okay, I sold my property, I've got my gain, I took that cash, now I'm going to go out and buy something new. I can defer that gain, right? Once I take that cash, I have boot and I can't just go and buy another property and defer it. A couple of items of note. We have had quite a few storms in 2022, Hurricane Ian being one of the larger, and there are some extensions for deadlines for qualifying taxpayers. So if you have a qualifying taxpayer that has deadlines falling on or after the disaster, obviously you want to look at this and do the research to make sure that they qualify for these extensions. In some cases, they can get 120 days added to each deadline for identification and replacement. So if you have property or deals in those areas, you may want to look into this to see if you are impacted or have the opportunity for extension. Another new item in the past year is Pennsylvania 1031 exchange, now recognized for individuals and partnerships. So for years beginning after December 31st, 2022, Pennsylvania now conforms its state tax code to the Internal Revenue Code for 1031. So that was a big area of concern for Pennsylvania residents and Pennsylvania investors. Now 1031 is available for property in that state. So to wrap up the 1031 topic, key takeaways, 1031 is only available for real property and the taxpayer needs to plan in advance. You can't touch the proceeds without taxable boot. Keep in mind that it's just the real property. So if you have an exchange that includes more than real property, you'll have to bifurcate it. You can't exchange for partnership interests, so you will need to do some special planning, consult your tax advisor for that. And if you're not sure if what you're exchanging qualifies as real property, the final regs provided a lot more clarity on that. So again, we can help out with something like that. Or there's a lot of information out there as to what exactly is considered real property for 1031 purposes. Next slide, please. The next deferral opportunity I'll talk about is qualified opportunity zones, which is a unique initiative that allows taxpayers to preserve their capital gains and defer that gain into the future. So the taxpayer can defer an eligible gain by investing some or all of their gain into a qualified opportunity fund. Again, there are rules and regulations on that. It has to be within 180 days of the sale to invest within the fund. The fund can be a C Corp, an S Corp, or a partnership, but there are requirements as to how much of the assets of the fund need to be invested in qualified opportunity zone business property, or that business could face a penalty. I believe there was some relief for the penalties during the pandemic, but I think those ended in 2021. So the property must be in the opportunity zone, or they must be invested in a qualified opportunity zone business. And there are 3 benefits, 2 of which are still available if you invest in a opportunity fund. The first benefit is the deferral of your capital gains from that original investment. So you sold a capital asset, you've got a capital gain, you don't want to pay tax on it today, you can invest in an opportunity fund, and you can defer your capital gain to either the sale date, if you sell before this date, or 12/31/2026. So if you still hold your interest, 12/31/2026, your tax on the capital gain comes due. This applies to also 12/31 gains, and the capital gains retain their character. So if it was a short-term capital gain and you hold the investment to 2026, you have a short-term capital gain that you'll pay tax on. Important to note, since we're talking about real estate, when you have depreciation recapture, that does not qualify for deferral. The second benefit that's no longer available is the potential for permanent exclusion of the initially invested capital gain. There were benchmarks of 5 years and 7 years of holding that allowed you to increase your basis to 10 and 15 years. You can't hold the property if you invested in 2022 for 5 years until 2026. So this benefit is no longer available, but if you did get in 2020 or 2021, it's possible that you can hold your investment for 5 years and increase your basis of the deferred gain. And the third benefit is the potential step up in basis of the qualified opportunity fund investment to fair market value on the date of sale if held for at least 10 years. So what this means is that your post-investment appreciation in the opportunity fund can be permanently excluded if you hold that investment for at least 10 years. So there's still 2 benefits. If you have gains at the end of the year, or if you have clients with gains at the end of the year, that they can still defer that gain until 12/31/2026. And if they hold it for over 10 years, that potential appreciation in the investment can be permanently excluded. A couple things on what is an eligible gain. An eligible gain is a gain that is treated as a capital gain. It can be short-term, long-term, net 12/31 gain, just not ordinary income. And it can't arise from a sale or exchange with a related party. When we're talking about 12/31 gains, the taxpayer has to wait until the end of the year to complete the netting process. With 12/31, you net gains and losses, and the 180-day period begins on the last day of the tax year because they have to wait to the end of the year for the netting. So that actually can give you a longer investment period, and that's a little helpful. When we're talking about, wrapping up the 2 ideas, opportunity zones versus a 1031, there's some key differences. If you invest in an opportunity zone, it doesn't require advanced planning as much as a 1031 does. As I mentioned, your money from the sale needs to go into a qualified intermediary for a 1031 exchange. That's not required for an opportunity zone investment. You can also get more time to invest in certain cases for the opportunity zones, whereas for a 1031, you have the 45-day identification period and to close within 180 days. For a 1031, you currently have to exchange real estate held for investment, whereas for an opportunity zone investment, it can be any kind of business within that zone. And for a 1031, you actually have indefinite deferral until you recognize that gain, whereas in the opportunity zone, you only have the deferral of your gain until that 12/31/2026 date. So that is important to keep in mind. So there's key differences, but two real opportunities here to think about. One that requires advanced planning, and the other that doesn't as much, but there are timelines that you have to stick to and keep in mind, because you don't have an infinite amount of time to reinvest. You have to reinvest within 180 days for the opportunity fund. And for the 1031, you want to get somebody involved right away. That's all I have.
No, thank you. There's a couple questions, so you're not off the hook just yet. First one relates to 1031 exchanges. When there is boot received or boot paid, the 1031 exchange cannot be applied. Is that correct?
Cannot be applied?
Cannot be applied. And I can't tell if it's cannot be applied to the boot received or cannot be applied at all from the way the question is worded. But I think ultimately, I think that falls into kind of the buckets of partial 1031 exchanges, right? You want to just talk about that a little bit?
Yeah, so you can have a partial 1031 where you defer a portion of a gain or sale and you recognize a gain and pay tax on another portion. If that is the question, if you received cash and you deferred some of your gain, you would bifurcate it and you would defer the portion that's deferred and you would recognize and pay tax on the portion of boot that you received.
All right, I agree with that. And so you could have that partial exchange. There's a couple questions on opportunity zones. I don't know if you just want me to answer them or you want to try to answer them yourself, but it's up to you. No, I saw that. I think you want me to. So the first one is, do you need to invest in a qualified opportunity zone fund by 12/31? The short answer is no. As Sarah mentioned throughout, the investment timeline or the reinvestment period for an opportunity zone deferral would be 180 days from the gain event. So if we're talking about a partnership reinvesting its gains, or an entity reinvesting its gains, or an individual, I sell stock in my investment portfolio, I need to reinvest those gains by December or by 180 days from my gain event. So if I wanted to sell stock today, generate a capital gain, and reinvest in an opportunity zone fund, I don't actually need to do that until 180 days from today. So I could sell, realize a gain on December 5th of 22, reinvest it by, and I'm not going to get the 180 days right, but it's sometime in early June, right? So reinvest it on or around Memorial Day of 2023, and I can still back that amount off of my 2022 tax return, so long as I invested in a qualified opportunity zone fund. Now, obviously, practically, you're going to need to extend your personal tax return or your entity tax return and have that extension in place so you can properly report it on the tax return and back it off. You're not going to want to file in April, reinvest in May or early June, and then need to amend your tax return to back it off. But ultimately, you would go ahead and you would defer that off of your tax return. I see the follow-up question that they asked, how do I report it? In that case, you would just back it off of your 2022 tax return, which is, again, why I would say extend until that 180-day period passes so that you can back it off properly. You wouldn't want to back it off and then miss the deadline and then have to amend to include it. You wouldn't want to include it in taxable income. And I've seen people do this, and we've had to amend tax returns. They include it in taxable income, they file, they pay the tax, then they realize they have an opportunity zone opportunity. I hate the word using it twice, but that's the only way I know how to do it. Then they realize they can say, oh, I can defer this if I invest in an opportunity zone fund. So I'm going to invest in an opportunity zone fund, and I'm going to go back and amend my tax return accordingly. So that's how you would do it. It is open through that 180-day period. No need to do it by the end of the year. So if I were to sell today, I don't have 3 weeks to invest. I do have the 180 days to invest, and there's just some special rules around the reporting and the timing in how you go ahead and defer it off the tax return. if you have a pass-through entity and you're the owner of a pass-through entity and that pass-through entity has a gain event, there's even more complex rules with respect to timing and when you need to reinvest those funds at the individual level. The one nice thing about opportunity zones, as compare and contrast with 1031s, as Sarah was doing there at the end, if an entity is the selling taxpayer in a 1031 exchange, that entity needs to be the acquiring taxpayer. The individual partners in that partnership cannot choose to do a 1031 on their own if the partnership sold the asset. With opportunity zones, a partnership can sell the asset, and the partners of that partnership can then choose individually to leverage the opportunity zones to defer their share of the gain. A lot of special rules around that exist, and it does not need to be consistent. So if 2 partners want to invest in opportunity zone funds and 3 partners want to take their money and go separate ways, they can do that. Those 2 partners don't need to be in a business together or invest in the same opportunity funds. They could do different things with their money. They can invest, one of them can do an opportunity fund and do a real estate deal. One of them can do an opportunity fund and do a trade or business. So there's a lot more flexibility there with respect to gains realized at an entity level, a pass-through entity level, with respect to the individuals and their ability to go ahead and defer some of those gains. So a lot of nuance there with the opportunity zone funds, but none of that needs to take place by December 31st. It's that 180 days on individual gain. And then with respect to pass-through entity gains, it's 180 days from the gain event, or 180 days from year end, or 180 days from the due date of the pass-through entity tax return. A lot of things to take into account there. Happy to discuss offline because I don't want this to turn into an opportunity zone webinar as it's starting to do. Next question, is there an election that needs to be made when the taxpayer wants to defer eligible gain for an opportunity zone? You want to take a stab at that one, Sarah, or you want me to just do it?
I believe you just back off the gain. There's an election for the actual fund, but as the taxpayer, you just report that that has been reinvested.
That is correct. That is correct. There's no formal election at the individual level. Just back it off the tax return in accordance with the instructions for the 8949, file the 8997, and you've achieved deferral. And I think those are the questions related to your section, Sarah. Before we move on to 2023 stuff, I want to bring Ryan back up. Ryan, we have another question for you that came in, if you can jump back on.
Sure.
So we do have a question about bonus improvements for things like gas stations and pad sites. If we're doing pad site work, we're setting up gas stations and getting them ready for pad sites, does bonus apply to those improvements?
I mean, Brian, you could chime in. I would think any land improvement, general land improvement's going to qualify for the bonus depreciation. There are special rules that relate to gas stations that I would love to, whoever asked the question, if you wanted to touch base with, myself or Brian after the webinar, there are special rules where the convenience store associated with that gas station may also qualify for a 15-year life, which also could, potentially benefit from the 100% bonus depreciation. So to answer your question, in a halfway, yes, I believe there is eligible cost there to take bonus depreciation, and there may be, additional room to take more, depending on some of the special rules the IRS has relating to gas stations and the convenience stores that are located on the site.
Yeah, I agree with that. Yeah, and the answer is yes, probably. Unfortunately, there's so much nuance around this, right? But if you're just getting a pad site ready, doing the improvements, laying down the utilities, the parking lots and things like that, and you're getting a pad site ready and turning it over to someone, I would think that what you're doing there is placing in service land improvements, and those land improvements, I think, as Ryan mentioned, that's a 15-year maker's asset that's going to be eligible for bonus. If you're doing more and you're building out the pad sites and the store around it and gas stations, definitely worth a look to see if it would qualify under some of the special rules that exist and would shorten the life of those assets and make them eligible for bonus depreciation. So feel free to follow up with us afterwards. We'd be happy to have that conversation. Thanks, Ryan. All right, and now I don't get to turn my microphone or my camera off because it's my turn to talk a little bit about, and Alex, you can slide through. There you go. Talk a little bit about the Inflation Reduction Act, some changes that take place for 2023 and beyond. So everything we talked about now, these last few 30 minutes or so, was just what can you do for 2022? What are the rules? Kind of what changes are out there that are happening? Some of these things, you know, we knew in 2017 with the Tax Cuts and Jobs Act, we knew these changes were coming. We knew bonus depreciation was scheduled to phase out. We knew the definition of ATI was changing with respect to 163J. I think a lot of people would have expected sometime between 2017 and now, some of these things would have been changed or fixed or buttoned up. You know, bonus depreciation has been scheduled to phase down every year, probably since, I don't know, when it came about in 2001. It's been on the radar of phasing, and every single time we get close, it gets kicked down the road a little bit further. At this point, this is what we have and we know. So Inflation Reduction Act was the big legislation over the summer. Did not touch any of these, you know, Tax Cuts and Jobs Act things. There were a lot of conversations about that definition of ATI. There were a lot of conversations about state and local tax deductions and all these other things that, you know, earlier this year we thought would have seen some level of legislation before year end, and did not happen. The Inflation Reduction Act, from a tax perspective, was largely about incentivizing clean energy. Turns out to be a legislation that provides a ton of incentive for clean energy projects, for energy efficiency, and reinstates a lot of programs that were on their way out. If we have time when we get to the end, we'll talk about the residential solar energy credit. I mean, that residential solar energy credit was phasing down rapidly. The investment tax credit as it relates to solar tax projects or solar panel projects, solar projects in commercial and the business sense, was phasing rapidly and was scheduled to be gone in a few years. The Inflation Reduction Act came in and really bolstered a lot of these programs, provided a lot more benefit. And so I just want to spend a little bit of time talking about a few of them, just to kind of put them on your radar. These are things that are going to be effective largely in 23 for that window from like 23 to 32, about a 10-year window there for the solar and clean energy things. For the first thing we're going to talk about, which is, and you can go to the next slide, Alex, the inflation, or the Section 179D deduction. Section 179D has been a part of the tax code since I think 2006. And it provided for a real-time current year deduction for energy efficiency improvements that are made to buildings. That deduction was formerly up to $1.80 per square foot. The 179D provision was one of those provisions that on a rolling basis was scheduled to expire and was extended for a few years, was scheduled to expire and was extended a few years. Back in 2021, one of the Appropriations Acts made it permanent. So it kind of came off that, you know, every couple years extension bill chopping block, where you knew it was going to be part of the code. The whole entire purpose of the 179D deduction is to encourage taxpayers to provide, as they're renovating buildings, to make energy efficient improvements. The interior lighting systems, the heating and cooling, the ventilation and hot water systems, improvements to those systems that reduced annual energy expenditure by 50% compared to a standard would allow you to take a deduction on your current tax return and would allow you to, obviously it's a give and take, right? You're exchanging that deduction for depreciation, because as the building owner, you would take that $180 deduction if you qualified fully, and you would lower your basis and your depreciation by the amount of that deduction. So you're not double dipping, it's not creating anything new, it's not creating any massive savings, but it was $1.80 per square foot, depending on the size of your building. That's real dollars that you can deduct today. And instead of waiting 39 years in a non-residential real estate context, you would get that deduction today. Again, you had to improve those systems more than 50% against the ASHRAE standard. That standard was always kind of changing. As they extended it, they would make it a little bit more recent standard. But again, most of the building today, the way it's done, especially in jurisdictions like New York, where there's a lot of clean energy requirements on buildings, a lot of those buildings today are going to qualify and are going to meet that standard. So that's okay. The standard, like I said, it was $1.80 per square foot. The Inflation Reduction Act really added a lot of value here. As long as you meet certain requirements, it added a lot of value here. The deduction can now go up to as high as $5 a square foot. Now, what they did is they provided a little bit of a sliding scale. So depending on how much energy efficiency, how much better than the standard you are, the better, the more you get. So if you're 25% more efficient, you're not going to qualify for the full $5. And as you slide up that scale, you're going to qualify for more and more of the deduction. The one thing that you'll see throughout this, in the next two topics we talk about, is this prevailing wage and apprenticeship requirement for the full benefits. That is a provision that they've added here to require builders to use prevailing wage and to in some cases utilize apprenticeship. Enough of the work needs to be done by apprenticeship programs. So just recently, I think last week, or maybe, yeah, I think it was last week, because we're talking right after Thanksgiving, the IRS came out with some guidance as far as how they're going to set those prevailing wage standards and what they're going to do with respect to apprenticeship. So a lot of that is pretty new, and it's pretty important to, kind of follow this if you're looking for these standards. So they're going to be providing prevailing wage rules based on the jurisdiction that the building is done. So that's obviously going to be a geographic thing as far as how much, the prevailing wage is and what payments are made. From an apprenticeship requirement, there's some good faith provisions in there that says if you try as a builder, as a building owner, you try to get enough apprenticeship and you go out to local apprenticeship programs and you're unable to, but you made a good faith effort, you're not going to be penalized. But in order to fully qualify for that $5, you're going to need to meet those prevailing wage and apprenticeship requirements to get to that $5 benefit. The one nice thing about the 179D deduction for those builders or owners on the phone who do work for tax exempt entities, it used to be under the old rules that if you were doing work for a tax exempt entity that was a government type entity, schools, hospitals, things like that, you could that tax exempt owner could assign the deduction to the primary designer of the energy efficiency. So in that case, now you're doing work for a school, you're doing work for some kind of governmental building, a municipal building in town. As the designer, you can take that 180 a square foot and not have any basis to offset, right? For the designer of the building, that's a free tax deduction. But it was limited. It wasn't all tax exempt owners. It was only those public nonprofits. So now it is available under the Inflation Reduction Act. That assignment of the deduction is available for all buildings owned by tax exempt entities. So if you're doing work as a architect, engineer, or a contractor for a tax exempt entity, that tax exempt entity has the ability to assign that deduction to the person primarily responsible for the energy efficiency improvements, and they are then able to take that deduction again without the basis offset. Free deduction for those folks. So that's a big expanded definition here of who can claim that credit or that deduction, and it's really going to be valuable for a lot of folks who operate in those spaces. Alex, you can go to the next slide. The Section 45L energy efficient home credit is another one that was expanded under the Inflation Reduction Act. That used to provide, prior to the Inflation Reduction Act, it provided a benefit. I believe that old benefit was $2,500 a unit. There were some rules around the size of the buildings and things like that. What the Inflation Reduction Act did here is expanded the program pretty substantially. The maximum credit that's allowed now for single family homes is up to $5,000. In order to get that $5,000, you have to have a zero energy ready home. You're going to be building zero energy ready homes. That credit is then $5,000. For Energy Star single family new homes, the national program, it's up to $2,500. So depending on the energy efficiency of the home that's being built. So this credit under 45L is a credit, and it's available for home builders. There are some special rules with respect to multifamily. Multifamily units, the credit per unit is $1,000. It drops to $1,000, and that Energy Star is $5,000. But if you're building multifamily and you meet the prevailing wage requirements, same prevailing wage requirements that we had when we talked about 179D, that credit can increase up to $5,000. So here's where you're really seeing the, for builders of multifamily who are using prevailing wage, they get to take that maximum credit from $5,000 from 1,000 up to 5,000. This can be taken in addition to 179D if you're building if you're building some homes for rent and some homes for sale. So the big expansion here is, again, just to note that this credit is out there. It's expanded. It's more available. Depending on the energy efficiency standard to which you're building, it can be up to that $5,000 if you're meeting the prevailing wage. The other thing that's nice about the Inflation Reduction Act, it used to be that if you were doing a multifamily building greater than 3 stories, you did not qualify under 45L. The residential building limit, that 3-story limit, is now gone. So if you're looking to take advantage of 45L and you're building something bigger than 3 stories, where in the past you may have looked at it and you were no longer eligible, starting in 2023, you are now eligible to look at 45L again, and you can look at taking these credits that were available for you. Next slide, Alex. And the last thing I want to spend some time, the next 2 slides really talk about the investment tax credit, or the solar investment, really focused on the solar side. If you follow this space, you know, and I know I had a lot of clients that were looking at doing it for their home. The credit was 30% prior to the Inflation Reduction Act. That was scheduled to be 26% in 2022, 22% in 2023, and then it was 0. There was no more law after that. It sunsetted, it expired, and solar energy incentives just didn't exist anymore. So the Inflation Reduction Act came in and it reinstated that 30% credit. And the nice thing is it reinstated it for starting in 2022. So this is a current change that affects your 22 year and will affect the next 10 years in effect. That phase out is now pushed to 2033 and 2034. So right on through the 2032 tax year, you have a full 30% deduction that is available. The prevailing, so the starting next year, now that they started to publish some of this information about the prevailing wage rules will come into play. So in order to qualify for that full 30% credit after these rules are introduced, you're going to need to meet the prevailing wage standards and the apprenticeship requirements. I'm pretty sure, and I'm looking to see if I see it in my notes, I'm pretty sure that once that gets placed in service, once those rules are in play fully, I think the credit prior to qualifying, like if you don't meet any of the prevailing wage or apprenticeship requirements, I think it starts at like 6%. And so in order to get the full 30%, you will need to meet those prevailing wage and apprenticeship requirements. They've also expanded this program a little bit to provide for a few, call them bonus credits, right? So a little additional credit. If these energy properties are placed in service in certain things they designate as energy communities, right? So they're usually low-income areas that are energy communities. There's an additional potential 10% credit amount. So instead of 30, now you're looking at 40. There's also a kicker in there for some domestic production content. So if you're putting in service energy property that satisfies a domestic production component, you can also get a 10% bump there as well. So they've reinstated the 30, which is good, because prior to that law, it was looking at a sunset for that industry and for those improvements. The big piece here, and I think you can flip to the next slide too, Alex, if you want, because I think the only part here is where I usually get it. Yeah. So it's very similar on the residential solar side. So the 48 investment tax, the Section 48 investment tax credit is the one we were just talking about. There's a residential component to that under Section 25 that follows pretty similarly, right? So 25D and the Section 48 credit all run pretty similar as far as the rules are concerned and what the credits are. It's increased back to that 30% again for that same window all the way out through 2032. The one question I get a fair amount is, what if I don't buy the system? What if I lease the system? I put the system on my roof, somebody else owns it, or I put the, I get it a lot in the context from building owners. I want to put this on my building, but so it can provide energy for my building, but I don't necessarily want to buy it. I want to lease it. Well, in those cases, the credits are available to the owner of the system. So if you're leasing the system from someone, you're not going to be eligible for these benefits, right? So 30% of the cost to place it in service, if you're not actually placing it in service and you're just leasing those assets, you're not going to qualify for these credits. The owner of the system is going to be the one that qualifies for the credit. So I just want to point that out. And that was really kind of what I wanted to touch on with respect to energy efficiency. Sorry, I'm checking the question sheet now. Is section 45L applied to residential real estate rentals? I think in the context of residential real estate rentals use, you can use 45L. I think there's some special rules around it. Definitely, if you want to explore that further, I'm happy to reach out to me. I'm happy to explore it further with you. It is largely, I see it mostly with the builders of the home, but they, the builder of the home can get that tax credit. There's one more question in there. Let me see if I can get that one out as well. Where can you look to see if you can find, if you're meeting prevailing wage and apprenticeships? Is there a government website? Yes, the guidance that came out recently, the IRS posted a notice last week. I can't think of the number off the top of my head. I want to say it was 2022-61, that they will be published by the government. There's nothing out there yet, but they will be published by the government, and it will be pretty easy to find, I think, once it's out there, as far as what the prevailing wage requirements are for a particular geography. That notice also provided some guidance with respect to apprenticeship requirements. So the IRS posted that notice. Like I said, I think it was 2022-61, and it came out just like last week. I'm looking real quick to see if I can find the site. Let's see, 2022-61. Yeah, it came out on November 30th. So you can certainly start there. As far as the best way to find some of that information was notice 2022-61 published by the IRS on November 30th. And then I have a question here: other than solar, are there other energy credits available? Yeah, there's an awful lot out there as far as energy credits are concerned. I know we're bumping up close to our hour, but certainly feel free to reach out. Happy to explore the stuff that's out there. Most of it is solar that we're looking at now, but wind, geothermal, all of those other types of energy will qualify for that investment tax credit. So it's not limited solely to solar. If you're looking at doing other types of clean energy programs, I mean, ultimately they're clean energy programs, not solar energy programs. So if you're looking at wind energy or geothermal or anything like that, those ITC, the Section 48 investment tax credit, is going to cover a lot of that investment as well. One more: do you have to meet both requirements for prevailing wage and apprenticeship, or do you just meet one? The way I read it, there's going to be different components that are going to, I think you need to meet both in order to qualify for the full credit. How exactly it's going to be implemented, where if you don't meet one but you meet the other, and how much eligibility you're going to have, I'm not fully versed in that right now to be able to answer that question. But if you want to reach out, as the guidance comes out more, again, the Inflation Reduction Act was signed in August, and the IRS just released a preliminary initial guidance on prevailing wage and apprenticeship. Their initial guidance was released on November 30th. So it is brand new. I think that was a 21-page notice with a bunch of their initial information. Ultimately, this is going to evolve as they start to get feedback and how they're going to implement that. So happy to have a conversation and keep you up to date as changes happen, but that is a really new and dynamic part of this Inflation Reduction Act that the IRS is getting around to issuing guidance on now. Rebecca, you want to take it and cover your last couple things? I know you had one thing you wanted to talk about.
Yep, absolutely. Thanks, Brian. So quickly, just for 2-3 minutes, wanted to talk about schedules K2 and K3. So for 2021, the IRS blessed us with some additional reporting requirements for flow-through entities that basically had to do with foreign tax credit reporting. So these were schedules K2 and K3. And as many of you who actually looked at your partnership or your S Corp returns realized, The K2 has up to 18 pages, and that's an entity level reporting form. But the bigger kicker was that the K3, which is distributed to each investor along with their K1, has up to 19 pages. Some of your returns might have been massively larger than they had been in the past. So for 2021, the forms had to be prepared for entities that either had foreign partners, foreign activity, or any entity where an investor had a Form 1116 in their tax return that we knew of, and that's how Withum approached it. And the reason we approached it that way, there was a very little guidance out there, so a lot of firms were trying to interpret what they actually had to do. So because the legislation was provided pretty late in the game for 2021 compliance, the IRS decided to be a little bit lax with their requirements, but they did still expect compliance nonetheless. So up until this past Friday morning for 2022, there was going to be a pretty onerous thing that needed to happen by flow-through entities. So according to the draft instructions, every partnership and every S Corp was required to include a K2 and a K3 in their returns with only one exception. And this requirement changed this past Friday afternoon. So the major exception is called the domestic filing exception. I'm going to use the term partnership only going forward just because that's typically what most of these real estate entities are filing, so just for purposes of conversation. So the first point that you had to get through for the domestic filing exception is that you had to confirm that the partner has no or limited foreign activity. So you may have a real estate partnership, everything's in the US, all your partners are US based. You would consider to have limited foreign activity if you had a foreign tax credit of less than $300. Let's say you had a small brokerage account with some stuff in there, and you might have had $250 of foreign tax credit flowing to your partnership that you had to report, and you got a 10A9 for that. So that's considered limited foreign activity. So as long as it's under $300, you're good. The second is confirming that your partnership has no non-US partners. And then third, and this is the new thing, you need to include a statement with the K1s to your investors that K3s are not being provided to the investors in the partnership. So up until Friday afternoon, what was supposed to happen is that partnerships were going to have to notify all of their investors in writing, if you met this exception, that they weren't going to provide a K3. And then the investors had until the filing of the tax return to notify the partnership if they wanted a K3, because let's say they have a lot of foreign activity on their, let's say, personal returns. So that relief from this notification requirement is going to save you guys a lot of time, because now you don't have to go notify every one of your investors in writing. It was either going to have to be email or a mail, and you have to get a response from all your investors. So good thing is they took that out Friday afternoon, and as long as you meet the domestic filing exception, little or no foreign activity, no foreign partners, and as long as you include that statement saying we are not going to provide the K3, you're in good shape. So if you do have foreign partners, you will have to do K2 and K3s, and those K3s have to give them to every partner in the partnership, even if you only have, for example, one foreign partner. So the requirements may change. These are draft instructions that we've gotten, which have changed a couple times now. But as the requirements do change, we will be updating our information on our website, and we will be informing our staff accordingly if we work with you on your tax compliance. So that's all I have. I don't think there are any other questions, Brian. I think we're ready to wrap up at 1:59. So I want to thank all of you for attending our presentation. As I said, it will be put out there on our website. And I'd like to thank not only Brian, but also Ryan and Sarah and Brittany for participating in this webinar. And we look forward to working with you this coming tax season. Again, if you have any questions, and I know there's some follow-up that Brian is more than happy to help with, along with our other panelists. So we appreciate your time, and wishing you guys all a happy holiday season. So take care, everybody.
Thank you, everyone.